Year after year, this client was losing about $50,000. Not once, not a one-time mistake, not one bad year. Every single year. That's $250,000 in 5 years, $500,000 in 10. And what makes this case so dangerous is that nothing looked wrong. The return was filed, income was reported, taxes were paid. No notices, no obvious errors, no red flags. On paper, everything was correct, but underneath something was leaking.
Wait, everything looked normal and they were still losing that much?
Exactly. This wasn't a filing problem. It was a structure problem. Quiet, consistent, and expensive. Welcome to IB Smart Tax. This is a tax leak case.
If it's that big, how did nobody catch it?
Because the return was correct. And that's exactly why it survived. Everything matched. Everything complied. Everything looked clean enough to move forward. No one was looking for waste. They were only looking for errors. And those are not the same thing. If a return is wrong, someone fixes it. If a return is correct but inefficient, it often stays exactly the same, year after year.
So they did everything right and still lost money?
Exactly, because right only means compliant. It does not mean efficient. It does not mean optimized. And it definitely does not mean you're keeping what you should be keeping. Do you know whether part of your income is being taxed at up to 15.3% extra? Not because you made a mistake. Not because you filed late. Not because the IRS flagged you. But simply because of how your income is being classified. And this has nothing to do with how much you make. You could be paying it at $80,000, $150,000, or higher.
So it's not about income level?
Exactly. It's about how your income shows up. If your income comes from partnership K-1s, guaranteed payments, or active business income, and you're involved in the business, part of that income can be treated as self-employment income.
Even with a partnership?
Yes, that's where most people get it wrong. They assume K-1 income is automatically tax efficient. But if it's active, it can still trigger that extra tax. And the tricky part is, this tax doesn't show up clearly. It doesn't warn you. It just shows up as a higher total. And if no one reviews how your income is structured, you could be overpaying year after year. Income increased, but the structure didn't. Revenue went up. Profit expanded. The business matured, but the tax treatment stayed where it started.
So they grew income but not strategy?
Exactly. And that gap is where the leak begins. Because tax does not respond to income alone. It responds to how income moves through the structure. When income grows, but the structure stays frozen, more money gets exposed to the wrong tax layers. And the longer that gap stays open, the more expensive it becomes. Their QBI deduction was very small. Compared to their income, it barely showed up.
Isn't that supposed to be up to 20%?
Yes, up to 20% of qualified business income. But in this case, they couldn't really access it. Not because the deduction stopped existing, but because of how the income was flowing through the business. Because QBI is not automatic. It depends on how the income is structured, how it's classified, and how the business is set up. Two businesses can earn the same income, but only one actually receives the deduction. And in this case, the structure kept that benefit out of reach. That's an important signal. When QBI is unusually small for the amount of income involved, it often tells you the structure is working against you.
So the deduction was there, but they just couldn't use it.
Exactly, and a deduction you can't use is not a benefit. It's just value left sitting on the table. Income was too high, so QBI was blocked. Not reduced. Blocked. Once income crosses certain thresholds, the rules tighten. And if the structure doesn't support it, the deduction becomes inaccessible.
So they're stuck?
Under that setup, yes. They were earning enough for the limitation to matter, but not structured in a way that let them recover the benefit. So every year, same income pattern, same limitation, same missed deduction. The business was a partnership, a very common setup.
That's normal.
Yes, and that's why so many people stay in it. But common doesn't mean efficient. In that structure, the profit flows through as active business income. There's no separation between one layer and another. Everything moves together. And that matters because once all profit is treated the same way, all of it is exposed the same way too.
So normal can still cost more?
Exactly. Normal can be familiar. Normal can be easy. Normal can even be compliant. And still cost far more than it needs to. In many cases, a large portion of the profit is subject to self-employment tax. Not just a small piece, not just a portion you can ignore, but the part of income that's treated as active earnings.
So not everything, but a big part of it?
Exactly. And that's the real problem. Because once that income is classified as active, it becomes fully exposed to self-employment tax. Now you're not just paying income tax, you're paying an extra layer on top of it. And even though part of that tax has limits, another part keeps going. So as income grows, that extra layer keeps scaling right along with it. That extra layer can be up to 15.3%, a full additional tax layer on top of income tax. Depending on how the income flows, a significant portion of it can be exposed. At $200,000 of income, that can mean tens of thousands of dollars. Gone.
Same income, but tens of thousands more in tax?
Exactly. Same business, same revenue, same effort, different tax outcome. Because the issue was never how much was earned. It was how that income was being classified and where it was flowing.
That's not an income problem, that's a tax setup.
Exactly. That's why they were losing $50,000 or more every single year. Not once, not occasionally, consistently. And once you understand that it repeats annually, the number changes shape. $50,000 becomes $60,000, then $90,000, then hundreds of thousands.
So it's not income, it's structure.
Exactly. The income didn't create the loss. The structure created the leak. We made one change. S corporation. Same business. Same income. Same operations. Only the structure changed.
Just one?
Yes, because the issue was never the amount of money. It was the way the money was being treated. Once the structure changed, the tax treatment changed. And once that changed, the leak stopped. Before, everything was taxed the same way. After, only part of it was. The income did not change, but the exposure did. And that difference was worth about $50,000.
So they didn't save money, they stopped overpaying.
Exactly. That's the right frame. Nothing artificial was created. No income disappeared. They simply stopped losing money through the wrong structure. Then everything improved. Not just one area, multiple areas. Because once the structure changed, it didn't just reduce one tax layer. It changed how the whole return worked. What was blocked started opening. What was inefficient started aligning.
One fix unlocked more?
Exactly. Good structure doesn't just reduce one problem. It makes other benefits usable again. QBI came back. About $10,000. Not newly created, recovered.
That money is always there?
Yes, the deduction existed, but the previous structure kept it out of reach. Once the structure changed, access changed. Same rules, same business, different outcome. Then there were the smaller leaks. HSA expenses, other overlooked items. Individually, none of them looked dramatic, but they repeated.
Small but constant?
Exactly, and that's why they matter. A few hundred here, 1,000 there. Over time, they accumulate. And when no one reviews them, they just keep draining value quietly. Total, $30,000 to $50,000 every year. Not from one issue, from layers stacked together. The mean structure, the blocked deductions, the missed access, the smaller leaks.
That's basically a salary.
Exactly. That's real money leaving the system. And because it repeated annually, it compounded fast. The real question is not can you fix it? You usually can. The real question is how many years this has already been happening. Because once you see the leak, the correction is clear. But the years already lost don't come back.
That's scary.
Exactly. Because the biggest cost is not just the money. It's the time the structure was left untouched. The good news is, once you see it, you can fix it. This is one tax leak. There are many more. Different forms, different patterns, same result, money leaving without being noticed.
And people don't even know.
Exactly. That's why this matters. Follow, and I'll show you where your money is leaking.